In the summer of 1929, while the rest of America was dancing in the roaring 20s, Joseph Kennedy quietly sold everything. He didn't just step away from the table, he bet the casino would burn down. 6 months later, he was worth millions. In 2007, while the world was buying homes they couldn't afford, Michael Burry locked himself in his office, stared at spreadsheets of mortgage bonds, and bet against the American dream. He walked away with $700 million. Now, in 2025, the same silence is falling over the market. The music hasn't stopped for the public yet, but for the smart money, the party is already over. There is a pattern in financial history, a sequence. It is not random. It is not luck. It is a 4-stage algorithm of human psychology and market mechanics that repeats every single time valuations reach the breaking point, while ordinary families hold their stocks all the way down. Watching their retirement evaporate in weeks, a small, ruthless group of operators positions themselves to profit from the ruin. They don't cause the crash, they just see the math. And right now, in 2025, we are watching the exact same investors make the exact same moves. Warren Buffett is sitting on $325 billion in cash. It is the largest defensive position in the history of capital markets. Jeff Bezos has liquidated $13 billion in Amazon stock. Mark Zuckerberg is dumping Meta shares at record speed. This isn't estate planning. This is an exit. Let me show you the mechanism. Let me show you the 4 stages of the crash profit pattern, from the silent exit to the violent collapse, and prove to you exactly where we are in the cycle right now. Because if you don't see what they are doing, you are the one they are selling to. Stage 1, the exit 12 to 18 months before this, is the phase of deception. The market is still rising. The headlines are euphoric. The average investor is borrowing money to buy more. But the sophisticated money, they are quietly handing their bags to the public and walking out the door. In 1929, Joseph Kennedy was one of the sharks of Wall Street. He ran stock pools, manipulative schemes that drove prices up artificially so insiders could sell at the top. He knew the game was rigged because he was one of the riggers. The famous legend says Kennedy sold his stocks because a shoeshine boy gave him a tip. If the shoeshine boy knows as much as I do, he supposedly said, it is time to get out. It is a great story. It is also a lie. Kennedy didn't sell because of a shoeshine boy. He sold because of leverage. By 1929, margin debt had exploded. Investors were borrowing 90 cents for every dollar they invested. Kennedy did the math. He knew that a mere 10% drop in the market would trigger margin calls. Those margin calls would force selling. That selling would drop prices further, triggering more margin calls. He foresaw a mathematical cascade, a doom loop. So, throughout the summer of 1929, while the Dow Jones hit new highs, Kennedy and his peer, Bernard Baruch, were moving to cash. They didn't time the top perfectly. They didn't need to. They just needed to be out before the leverage unwound. The Dow peaked on September 3rd. The crash began October 24th. 7 weeks later, by the time the public realized what was happening, Kennedy was already safe on the shore, watching the ship go down. In 2008, the players changed, but the mechanics were identical. Michael Burry, running Scion Capital, didn't look at margin debt. He looked at the quality of the loans. In 2005, 3 years before the collapse, he started reading the thousands of pages of boring prospectuses that backed mortgage bonds. He saw the rot. He saw interest-only loans. He saw borrowers with no income verification. He saw a financial system built on sand. Burry and another outsider named John Paulson entered stage 1. They stopped believing the narrative that housing never goes down. They exited the consensus. They pulled their money out of the popular trades and prepared for war. This brings us to today, 2025. Who is in stage 1 right now? Look at Omaha, Warren Buffett, the Oracle. In his 2024 shareholder letter, he dropped a quiet bombshell. He said he cannot find anything attractively priced. Translation: everything is a bubble. Buffett's favorite metric, the Buffett indicator, which measures the total stock market value against the entire US GDP, sits at 185%. Buffett has historically said anything over 120% is dangerous. At 185%, it is a siren screaming in the night. He isn't just cautious. He is liquidating. He is selling Apple. He is selling Bank of America. He is building a fortress of cash. And look at the tech oligarchs. Jeff Bezos, Jamie Dimon, the CEOs, who have access to real-time data that you will never see. The real consumer spending, the real supply chain costs. Insider selling has reached levels not seen since 2007. They are not selling because they need pocket money. They are selling because they know that valuations based on infinite AI growth are mathematically impossible to sustain. While retail investors are buying the dip, convinced that the tech revolution will last forever. The people who own the revolution are cashing out. Stage 1 is complete. The smart money has left the building. But leaving isn't enough. To make billions, you have to bet on the destruction. Once the smart money exits, they don't just sit on their hands. They enter Stage 2. Stage 2, the insurance, 6 to 12 months before this, is the most difficult psychological phase. This is the quiet bet. In this stage, investors stop playing defense and start playing offense. But they do it subtly. They buy volatility insurance. In modern terms, this means buying put options, VIX calls, or credit default swaps. The genius of Stage 2 is timing. You buy the insurance when the sky is blue, when everyone feels safe. Because when everyone feels safe, insurance is cheap. Let's look at history. In 1929, financial instruments like options were primitive. So Joseph Kennedy used the tools of his time. After exiting his long positions, he began shorting. Shorting is the act of borrowing a stock, selling it at the current high price, and promising to buy it back later. But you are betting on failure. Through the autumn of 1929, Kennedy was paying interest on these borrowed shares. He was bleeding money daily as the market ticked higher. To an outsider, he looked like a fool betting against American prosperity. But he knew he was just paying a premium. He was buying a ticket to the crash. When Black Thursday hit in October, the trap snapped shut. As prices plummeted 30%, then 50%, Kennedy bought back the stocks he had sold for pennies. He didn't just protect his wealth, he multiplied it. Estimates suggest he made the equivalent of hundreds of millions of dollars in today's money. In 2008, this stage was defined by the Big Short. Michael Burry and John Paulson couldn't just short houses. You can't short a neighborhood, so they had to invent a way to do it. They went to Goldman Sachs and Deutsche Bank and bought credit default swaps. Think of a CDS as fire insurance on your neighbor's house. If the house doesn't burn down, you pay a monthly premium and lose money. If the house burns down, the insurance company pays you the full value of the house. From 2005 to 2007, Burry and Paulson were bleeding. They were paying millions of dollars a year in premiums. Their investors were furious. They screamed. They threatened lawsuits. They demanded their money back. Burry had to lock the doors of his fund. He wrote letters pleading with them to understand the math. He was paying pennies for insurance on a Titanic that had already hit the iceberg, but hadn't started sinking yet. When the collapse finally came, Paulson's fund made $15 billion. The premiums they paid were rounding errors compared to the payout. And we saw a masterclass in this recently, March 2020. Bill Ackman, the activist investor, in February 2020, while the market was ignoring a virus spreading in Wuhan, Ackman spent $27 million buying credit protection on corporate bonds. $27 million is a lot of money to you and me. To a hedge fund, it's a rounding error. 3 weeks later, the world shut down. The market crashed 35%. Ackman's insurance policy paid out $2.6 billion, a 101 return. In less than a month, he didn't predict the virus. He predicted the fragility of the system. So, what does Stage 2 look like right now in 2025? The insurance markets are flashing red. Look at the put-call ratio. This measures how many investors are betting on a drop versus a rise. It has been elevated for months. Institutional whales are quietly accumulating downside protection. Look at the VIX options. The VIX measures market fear. Right now, whales are buying massive amounts of call options on the VIX, expiring in mid to late 2025. They are betting that fear will explode. But the biggest signal, it is back in the credit market. Credit default swaps on commercial real estate. The cost to insure against defaults in office towers and commercial malls has spiked 400% since 2021. Someone, somewhere, is paying millions of dollars a month to bet that American skyscrapers are about to become worthless. They aren't guessing. They have done the math on occupancy rates and interest rates. They know the landlords are insolvent. And Bill Ackman, he is back. In letters to investors, he has hinted at new hedges. He is talking openly about the risks in the banking sector and real estate. He hasn't disclosed the trade yet. He doesn't have to, but the language is the same as 2020. He is buying the insurance policy again. But insurance is just a general hedge. To make the real money, the empire building money, you have to be precise. You have to know exactly which pillar is going to crumble first. That brings us to stage 3, the sniper shot. Stage 3, the precision short, 3 to 6 months before this is the sniper phase. Stage 1 was moving to cash. Stage 2 was buying general insurance. Stage 3 is actively attacking the weakest link in the chain. You don't short the market, that is too expensive. You identify the specific sector, the specific company, the specific lie that is about to unravel. In 2008, Michael Burry didn't just bet against housing. He analyzed the loan level data. He found the specific bonds backed by mortgages in Florida, Nevada, and California, the epicenters of the fraud. He targeted the adjustable rate mortgages that were set to reset in 2007. He knew the exact date the homeowners would default. John Paulson went further. He realized that if the mortgages failed, the banks holding them were dead. In late 2007, while Wall Street analysts were still rating Lehman Brothers and Bear Stearns as strong buys, Paulson was shorting them into oblivion. He knew they were insolvent. He knew their assets, those toxic mortgage bonds, were worth zero. When Bear Stearns collapsed in March 2008, its stock fell from $170 to $2. Paulson didn't just win, he wiped them out. So where is the weak link in 2025? Where is the smart money aiming the sniper rifle right now? It is a two-front war: commercial real estate, CRE, and regional banks. This is the death spiral that most people are ignoring. Let's look at the math of the office tower. We have office buildings across San Francisco, New York, and Chicago sitting 40% to 50% vacant. Remote work isn't a trend anymore. It is an economy, but here is the killer. These buildings were bought with debt when interest rates were 3%. Now trillions of dollars of that debt is coming due. It needs to be refinanced. But rates are now 7% or 8%. A building that was barely profitable at 3% is mathematically bankrupt at 8%. We are already seeing the defaults. Brookfield, one of the largest asset managers on earth, simply walked away from huge towers in Los Angeles. They handed the keys to the bank. They said, "Keep it. It is worth less than the loan." And who holds those loans? The regional banks? The big banks, JP Morgan, Bank of America, they are diversified. But the small and mid-sized banks, they are loaded to the gills with commercial real estate loans. 30%, 40% of their loan books are tied to buildings that are emptying out. We saw the preview in 2023. Silicon Valley Bank, Signature Bank, First Republic, they failed because of interest rate mismanagement. But the next wave of failures, the one the smart money is positioning for right now, will be because of credit defaults. When the landlord hands the keys back to the bank has to write down the loss. When the losses exceed the bank's capital, the bank dies. Hedge funds are currently building massive short positions against specific regional banks with high exposure to office real estate. They are looking at the quarterly reports, finding the banks with the worst loans in the emptiest cities, and they are betting on their extinction. Politicians call this predatory. They say short sellers cause panic. But that is backward. The banks are already dead zombies walking. The short sellers are just the coroners. This is stage 3, playing out in real time. The positions are set. The premiums are being paid. The trap is armed. They are waiting for the trigger. Maybe a major REIT bankruptcy. Maybe a geopolitical shock. Maybe just a slow grind of higher rates breaking the consumer. And when that trigger is pulled, we enter the final phase. The phase where fortunes are not just made, but transferred. The slaughter and the feast. Stage 4. The buy maximum fear. This is the culmination. The moment the trap snaps shut, the wealth is transferred, and the smart money changes its skin. They stop being bears. They become bulls. When the panic is total, when the news is apocalyptic, when the average person vows to never touch a stock again. This requires a psychological fortitude that 99% of humans do not possess. And it requires the massive cash reserves built in stage 1 in 1932. After the market had fallen 89%, Joseph Kennedy stopped shorting. He looked around at the wreckage of the Great Depression. Real estate was selling for pennies. Companies were trading for less than the cash in their bank accounts. He started buying. He bought distressed real estate. He bought shattered companies. He built a dynasty on the ruins of the Roaring Twenties. In 2008, the bottom hit in March 2009. The S&P 500 was down 57%. The headlines asked, "Is capitalism dead?" Enter Warren Buffett. In the darkest hour of 2008, when Lehman had failed and the world was ending, Buffett took his cash and deployed it. He wrote a check for $5 billion to Goldman Sachs. He wrote another $5 billion to General Electric. He wasn't gambling. He was dictating terms. He got preferred shares paying a guaranteed 10% dividend, plus warrants to buy stock at rock-bottom prices. It was free money. Goldman Sachs needed his reputation to survive. Buffett lent them his credibility and charged them billions for it. And Bill Ackman, the man who turned $27 million into $2.6 billion in March 2020, while he was on TV telling the world that hell is coming, his fund was quietly doing something else. They were closing their insurance shorts and buying stocks. He took that $2.6 billion windfall and poured it into Starbucks, Hilton, and Lowe's, great companies that had been crushed by the virus panic. He made money on the way down. And then he made a fortune on the way up. That is the pattern executed to perfection. So, 2025, we are currently in late stage 3. The crash hasn't happened yet, but the gun is loaded. Commercial real estate is cracking. Regional banks are trembling. The buffet indicator is screaming. When the break happens, whether in 6 months or 18 months, it will be brutal. Unemployment will spike. The media will sell fear 24/7. Your instincts will scream at you to run. But look at the sidelines. Private equity firms, Blackstone, Apollo, KKR, are sitting on record amounts of dry powder. Hundreds of billions of dollars raised from investors, sitting in cash, waiting. They aren't buying today's bubble. They are waiting for the fire sale. They are waiting to buy those office buildings for 30 cents on the dollar. So, what do? You are not Warren Buffett. You can't demand 10% dividends from Goldman Sachs, but you can use the pattern. 1. Respect. Stage 1. If you are fully invested in higher risk assets, understand that you are the liquidity for the billionaires exiting. Raise cash. Cash is not trash. Cash is an option to buy the future at a discount. 2. Simple put options on the S&P 500 or holding short-term treasuries can act as your insurance policy. You pay a small premium to sleep at night. 3. Prepare for stage 4. This is the most important part. Make a list. Write down the companies you love, the ones with low debt, strong moats, and essential products. When the crash comes, and it will, these stocks will go on sale. When the world feels like it is ending, that is the signal. That is when you switch from fear to greed. The crash profit pattern isn't a secret code. It is history repeating itself. The same for stages, the same transfer of wealth. We are watching the tide go out. The tsunami is forming. The only question is, when the water comes crashing back in, will you be drowning or will you be riding the wave?